LNG to be launched, unlike the other two, which are already in place and are being implemented with details that will be discussed. The joint purchasing system is to be launched by this summer. And under the joint purchasing system, all buyers are to commit at least 15% of the gas that they will need to meet their 90% storage fill requirement by November into a joint pool that will be aggregated and put out to public tender. They may put in more than 15%, but they're required to do 15%. And this has received some pushback by, not surprisingly, some of the larger companies in particular who believe they can do better on their own. Couple quick questions for our panel. They may address these in their comments, and if not, we'll address them afterwards as questions. You can see here, and this is from a graph provided last month by the ESMA, the sister agency of ACER. This is the European Securities and Markets Authority. The light green line is natural gas prices, and then you see the other commodities there, and you see the large peak in around September, shortly about the same time as that August 26th date I mentioned earlier. And then natural gas prices have substantially declined. So is this a question of a potential long-term solution for what was a short-term problem that's already being resolved by itself? We'll talk about that. Another question to be addressed is, will EU market intervention push cargoes to higher price markets? If you look at that little green circle on the right, you see that natural gas prices in Europe, in the UK, and in Asia are within a pretty tight band at the moment. So if we artificially cap one or push one down, will that just push cargoes to the other two? Of course, Henry Hub is at the bottom. Happy to talk about that separately. And in fact, Europe has been a beneficiary of higher prices. We see on the left, and this is data from EIA, that cargoes swung to Europe, of course, in the run-up to the invasion and during the invasion, and at the cost, on the graph on the right, of cargoes that would otherwise have gone to Asia. Can this just as easily be reversed? To what extent were these policy-driven switches versus price-driven switches? These are things to think about in terms of the impact of a possible cap or benchmark if it became more than voluntary. And lastly, last question I wanted to pose is, what are the unforeseen impacts or foreseen impacts? TTF as a gas index, liquid gas index, is used for both LNG and natural gas contract futures and hedging. What are the impacts of government manipulation of that market index? And here I just want to add one quote from the ESMA, ACER's sister agency. Since the end of August, again, remember that August 28 date, and then immediately the discussions that began right from there of possible government intervention. Since end August, the migration to over-the-counter markets has accelerated, with over-the-counter accounting for close to 40% of gross exposures of natural gas derivatives by end of December. Such mitigation presents risks as OTC markets are less liquid and transparent. The migration of OTC may also reduce liquidity and price discovery of public exchanges. And you see in the graph on the right, again, from ESMA, that you see the migration there in terms of the peach-colored part of the bar graph being the OTC share, and the green being the public markets or exchange-traded derivatives, ETD, and then the red line representing the percentage going to OTC. So that concludes sort of introductory remarks. We have three fantastic speakers. I'm going to turn it over to my co-moderator, Anna Mikulska. And Anna, why don't you take it away, introduce our speakers, and we'll go from there.
Sounds great. And it's my pleasure to introduce our speakers. We have a great set of speakers to provide a really great perspective, different perspectives, including the US, the European perspective, as well as the perspective from other markets like oil. So we'll start with Dennis Hesseling, who's the head of infrastructure, gas and retail department at European Agency for the Cooperation of Energy Regulators. He joined ACER in 2012, and he's responsible for the agency's energy infrastructure, gas network codes, and market monitoring and energy retail activities. He also, before he joined ACER, he worked as a head of unit in the competition department in ACM, and he was responsible for merger control and antitrust enforcement in the Dutch energy, telecommunications, and media sectors. Dennis will be followed by Peter Keevy. He's the managing director and global head of energy and environmental products. He's responsible for leading and developing CMA Group's suite of global energy and environmental products, including benchmark futures and options that help customers mitigate the myriad of risks they face in today's uncertain global economy. Peter has more than 30 years of experience in the futures and options industry, including 15 years as a trader of physical and financial energy products across the natural gas and crude oil and refined product markets. And we will close our panel with Mark Finley, who is the fellow in energy and global oil at Rice University's Baker Institute, our colleague. He has over 35 years of experience working in the intersection of energy, economics, and public policy. Before joining the Baker Institute, Finley was the senior US economist at BP. For 12 years, he led the production of the BP Statistical Review of World Energy, the world's longest-running compilation of objective global energy data. He was also responsible for the company's long and short-term oil market analysis and led the global oil market and transportation sector analysis for the long-term BP Energy Outlook. And Mark will draw upon some examples of establishing market indexes benchmarks on the oil side, focusing on the data, challenges, and market impact. So without more ado, I'll ask Dennis to share his screen and start. And for our viewers, if you'd like to ask any questions, please utilize the Q&A box, and we will gather those questions with Stephen, and hopefully we'll have time to ask at least some of them following the presentations. Thank you very much.
Thank you very much, Anna, for the kind introduction. And let me indeed take over from here for my intervention. I brought a few slides to illustrate how we see this story from the European perspective. And for those who don't know ACER, we're basically the counterpart of FERC in the US. That is probably the easiest way to quickly describe our role. What I'll speak about from the three topics are two of them because we are directly as ACER involved in those two. That's the LNG price assessment and this market correction mechanism. I can move the slides. Yes. Before doing that, I will say a few things in line with what Stephen showed about how we see recent EU energy market developments, because that's the background against which I think it's more meaningful to think about the LNG price assessment and this market correction mechanism. So let's start with the EU energy market developments over the last year or so, which were quite, well, extraordinary. One way to look at it is the price developments. We're showing here the TTF in blue, and then also for good measure in greenish, I think, the German power prices. Starting in January 21, that was still pandemic periods, prices were comfortably low, and then slowly going up even before the Russian invasion of Ukraine. So if you look back at what happened in the energy part, at least in Europe, we already saw a tightening of supplies, of gas supplies in the run-up to the Russian invasion, which was linked to Gazprom behavior towards gas storages, and which caused already some unrest in the European gas market. You see that reflected also in the power prices, or the top line in here. That's a reflection not only of gas prices, but also of additional factors, where we were really in a, if you want, a perfect storm. Stephen mentioned August last year. We had not just extremely high gas prices, but also very low nuclear and wind output. And that, of course, it's a really difficult circumstances to navigate. Having high gas prices in summer is strange. I mean, normally we have a summer-winter spread. Prices are high in winter and low in summer. That's why you store the gas in summer and you sell it in winter. Didn't work out last season, and so we also are thinking about these storage filling obligations, one of those new additions in the EU policy toolbox, and how they have been implemented, because maybe some of the buyers were not particularly price sensitive, and maybe that contributed to the very high price environment. What we've seen since is a much more benign environment. We have high storages in the high storage levels. We're lucky with the mild winter. We have a very steady supply, not just from pipeline, the remaining pipeline suppliers, but also from LNG. There's demand reduction. So overall, we're in a much better place now than we were even a few months ago. Now, one thing that contributed was the reaction of demand. And here's an interesting question, Stephen, you mentioned, is it a policy or a price response? We're asking ourselves the same question here. There was a clear policy in place by the EU governments to reduce demand. So there were measures taken, public policy measures taken in all member states to bring down demand. At the same time, the price levels were so high that most were, in any case, already considering whether they could or could not bring down their own demand for gas primarily, but also for electricity. If we look at the numbers, and what we're showing here is that there's a clear demand reduction overall in the order of magnitude of 20%, with a few exceptions. So it's almost across the board from households, industry, and power, but the power sector has some notable exceptions, which goes back to my previous remark about the difficulties some were facing in power generation. That's, for instance, the case in France, and you see France here as an outlier. Instead of less, they actually reduced, they increased significantly their gas consumption for power generation, despite the extremely high prices they had to pay. And that was simply because they had no other alternative at that moment in time. If you look at the supply situation, we're coming from a situation going back to January 21, that's to the left of this chart, where we had Russian suppliers overall supplying 42% of the EU gas supplies. That was mainly pipeline and a bit of LNG. That has, of course, been reduced significantly. We're now talking about around 7%, a bit of pipeline and still some LNG in there. And the fact that we managed that without any single supply interruption is pretty impressive, I would say. I think it shows the resilience of the European gas sector, the fact that we have built over the last decade or so a system of interconnection capacities, but also of common, as we call them, network codes, so the rules for using this gas network, which are common throughout the EU, and which allow to quickly adapt to changes in prices and changes in flows. LNG imports, also thanks to the US, are up by 74% year on year, and that basically saved us, together, of course, with the demand reduction, to have continuous supplies throughout this really difficult period. Storage levels were a particular concern, especially in the run-up to the previous filling season, when Gazprom was not filling its storages as it had been doing the decades before, basically. That's where the intervention came in to make sure there are now storage filling obligations in place. So the member states have to reach certain percentages. And you see that this really worked. The red line here on top is the latest one, so from 22-23, the ongoing one. And the gray area shows you the average of the last years. And so we're really on top part of this range, very comfortable going through this winter, helped also by mild weather. And that gives us a really good starting position for the next filling season towards the winter of 23-24. That's a bit of the background against these policy measures, and now I'd like to speak about the LNG price assessment we have to perform, and then later on also this market correction mechanism, as it is called, to show what has been added to the regulations in the EU. The price assessment is a new task for us as ACER. We have to create an objective price assessment tool, collecting real-time information on daily transactions for LNG. And we have indeed the power, as Stephen already mentioned, to get transaction data of LNG, which is destined for the EU. Entry into force end of last year, go live 2 weeks later. That was not easy, but we managed. And now we're further developing it also in terms of methodology. The first version was a bit, let's say, good enough, but of course not perfect. And we're developing the methodology as we move forward. What this is meant to do is to determine the prevailing market price for the value of LNG delivered to the EU. Now, we as ACER, we are a public agency, part of the EU. We're not a price reporting agency, but this gives us a task which is very similar to what normally a price reporting agency would be doing. We try to follow these IOSCO, the International Organization of Securities Commission's principles of, let's say, making sure that the methodology complies with those standards, even though it's not a legal obligation. What we focus on for the price assessment is the so-called spot delivery ex-ship market, which we take to be the best indicator of the value of LNG delivered at this final location, which is available at short notice. So here we don't look at the long-term contracts, which we know are in place for LNG, but they don't provide you an indication of what, as a shipper or a trader, if you want to get LNG to the market at short notice, this is what is basically available for you. We have to work on things like making inputs comparable to make sure that we're comparing like for like, and also to enable to establish trust, let's say, in this price assessment, so that later on, once it's more established, it can be taken up if they want to by market participants. There's no, as Stephen mentioned, there's no obligation here. This is a possibility. We're adding something in terms of market transparency and well, providing price signals, but there's no obligation to pick this up. We have published our price assessment methodology, and we're discussing it with an expert group of well, people from the sector, basically stakeholders, to see how this could be improved over time. So how does it work a bit more in detail? We collect spot transactions, spot orders, and also the long-term LNG contract executions. We get prices, quantities, delivery points, and dates. And then what we publish are two specific points, specific values. One is the price assessment for Northwest Europe, and the other one is for South Europe. And again, this is only spot and only delivery ex-ship, which is considered here, and we weight the price per the volume that is brought to the European shore. In order to do this, we need a number of data adjustments. So we use selected LNG terminals as a reference for these market areas, Northwest and South Europe. We look at cargoes which will arrive in the second half month ahead of the transaction, which is the big bulk of those. And we use a rolling window of 5 days. That's maybe the most tricky one, because this market, as you probably know, is highly illiquid. You're talking about a handful of transactions a day. That means that sometimes we simply don't have enough transactions to calculate a reliable price index without giving away commercially sensitive information. That means we need to use this rolling window to make sure we produce something which is still meaningful, close enough to a daily price assessment, but with still guaranteeing that the commercial transactions in there are safe and cannot be reverse engineered from our price assessment. What do you get? And this is what is available on our website on a daily basis. You get two price assessments, as you can see in the left part of this slide, one for Northwest Europe, one for South Europe. There's usually a bit of a spread between those two. In this case, it's less than €1 per megawatt hour, so it's not massive, but still. The southern one tends to be a bit cheaper. And they will provide a few data statistics to give a bit of feeling of how robust these numbers are. We provide the number of transactions, the number of market participants involved, a number of LNG terminals and things like that, and a few additional comments to provide transparency again to the markets. That's the LNG price assessment. That's, let's say, the voluntary part is more transparency, but you don't actually have to do anything. Market correction mechanism is a bit different, because here, if it is activated, it will have an effect on markets for sure. This is part of a broader package to address the energy crisis. LNG assessment that I just spoke about is part of what is called the October Solidarity Regulation. This one, the MCM, the Market Correction Mechanism, is meant to, in the words of our Commissioner for Energy, Simpson, to tackle excessively high gas prices in Europe when they are not justified by the situation in the global gas market. So the way it's framed politically, it's not like we start regulating derivative markets in Europe. That's not the goal. But if it is seen as not being justified by the global gas market, that is something which will be used as a mechanism of last resort and to address episodes of excessively high prices not in line with global price trends. That's also what you see back if you look at the way it has been developed. Stephen mentioned those two threshold values. One is the €180 per megawatt hour. That is for the TTF front month price. It should be above that for 3 days. The second one is cumulative. You need to meet both conditions. Is a spread of €35 per megawatt hour between TTF and the LNG reference price. So there should be a significant gap between the two, and you need to meet those two conditions: 180 plus 35, and otherwise the MCM is not activated. So what does it do? If it works well, it should limit the price premium created by the risk of supply disruption or even deliberate manipulations of gas supplies by Russia. The latter is getting more and more unlikely because there's simply less Russian gas to go around in the European gas system. It should also limit the premium that the LNG importers are paying compared to the world LNG markets. There can still be a premium, but there's a limit to that. And as also, at the same time, it should ensure that we can continue to attract, and it's the same question you put on the table, Stephen, we continue to attract LNG where it's necessary. So that if we need to compete for price with Asian LNG, we can still do it because we can pay a premium on top of what is paid in the global LNG markets. So a bit more in detail, what is included in this MCM regulation? There's a part which relates to price monitoring and the calculation of this reference price. That is a public thing, so people can see publicly on our website what the reference price is on a daily basis, and they can see for themselves, are we getting close to, well, the activation conditions, yes or no? There's a market correction event, which indeed we have to calculate, and we could trigger it if those two conditions are met, and that's kind of a mechanical exercise. We don't have any room for interpretation there. There's also the opposite in place. If it is activated, there's a deactivation mechanism, which basically works from the reverse way of the activation one. And there's a safeguard there, which is called the suspension of the MCM. And there's some criteria we could look at together with the European Commission and other entities like ESMA, the one that Stephen mentioned, which relate to security of supply, are the flows still going, is financial trading disrupted or not? If that were to be the effect of an activated MCM, the European Commission can suspend the functioning basically of the MCM. Then we have some effect assessments, and I'll come to that in a moment, to see, well, what has happened? What has been the impact of the MCM? And there's an ongoing discussion at this moment of extending the MCM, not just to TTF derivatives, but also to derivatives linked to other virtual trading bonds. And then there's a review clause in there. So we published our first report, which is called the Preliminary Data Report, in January, covering three main areas. What do we see in terms of gas price developments, gas flow developments, and gas trading developments? And our conclusion is basically that we don't see any significant effects of the adoption of the regulation. This report is from January. Regulation was adopted end of December. And since then, if we look at these indicators that we follow, we don't see anything that could be clearly attributed to the adoption of the MCM. We see prices going down. We don't think that it's because of the MCM. We think it's because of fundamentals. I spoke about that previously. We think that security supply has been well ensured. And also, we don't actually see a clear shift in trading activity. One of the concerns of the MCM was, well, maybe trading will move away from exchanges to OTC, from derivatives to spot, or even outside the EU to the MDP in the UK. That has not happened yet. And then the open question is, do we still see some effects? I mean, we have an upcoming report actually next week. We're looking at the same set of indicators. So here you see the TTF front month. That's the yellow-orange one on top. You see in red, in the final part of this chart, this reference price that we've started to calculate. You see the two activation conditions. We're very far away from that. So you can look at adoption of the MCM regulation, calculation of reference price, and entry into force of this mechanism. And you can ask yourself, do we see any effects of this regulation, yes or no? From our side, we don't actually see it, but of course, we're open to discuss, and also happy to take any comments from the audience here to see what their view would be. I will stop here and hand it back to Anna and Stephen.
Many thanks, Dennis. Let's hear from Peter now on the US perspective. Thank you.
Good morning, and thank you for your time and attention. And thank you, Dennis, for that interesting background. I wanted to speak with you today just to, so my background at the exchange is in developing benchmarks, and specifically listing and developing either physical settled or financially settled benchmarks. So a couple of comments that I'd like to make here. First of all, what makes a good benchmark, and what are the challenges in developing one, particularly in the LNG space? My personal experience is this. A little bit of background. LNG obviously has been around for 50 years, but the main benchmark effort started in the mid-2000s with a desire to develop an Asian benchmark, which is JKM. That was launched in 2009, the first real LNG focused benchmark. And that grew slowly over the last decade and a half and continues to be quite small relative to the large pipeline markets, TTF and Henry Hub. Obviously, Henry Hub, I believe, has upwards of 80% of the market share in traded derivatives globally. So every other market tends to be extremely small. And there's a variety of reasons for that. So in 2016, when Cheniere brought on Sabine Pass liquefaction and started putting US gas into the global space, there was a desire immediately through basically their merchant model, which was a Henry Hub indexed offtake of LNG, to develop traded benchmarks around that new flow. US LNG obviously grew pretty dramatically since 2016. We now put approximately 16 BCF a day of gas onto the global markets, and that is indexed largely to Henry Hub on a formula. However, it's a very challenging market to launch a benchmark. We attempted and did launch a physical settled FOB market. Physically settled FOB markets are the gold standard, sort of the holy grail of benchmarks, I think globally. Several challenges with the LNG space in developing new benchmarks. Firstly, the infrastructure is very, very rigid relative to the price of the underlying commodities. So I'll give you an example. In the Gulf Coast, we had significant challenges just with the scheduling of cargoes, as an example. The berthing schedule is set 2 years in advance with very little flexibility. The delivery of cargoes is highly orchestrated, which doesn't lend itself towards a vibrant spot market. So another requirement for a benchmark is, number one, underlying physical volumes. The LNG market clearly has that in several regions. Number two, common terms and locations. It's a real challenge in the LNG market. SPAs, the main offtake agreement, vary differently, vary greatly between different counterparts. There's force majeure language that has been a large struggle to reconcile between contract off-takers. A strong mix of participants, again, a large challenge here, because the participant mix tends to be quite concentrated, and only those with the largest balance sheet and capacity to manage the varying risks on the offtake. And then a large amount of transactions on the common underlying under a common structure that can then be assessed to develop a benchmark or at least a price assessment. So what's happened? The market has developed dramatically since 2016 with the onset of generally free-to-trade US cargoes, which are not limited by things like destination restrictions. The pricing formula is very transparent, and arbitrage became significantly easier after 2016. But that still did not solve the problem, because the bottleneck issue still tends to be very significant. So even moves into Asia, which have still gotten more traction, still requires the LNG benchmark to be adjusted. The assessment process is not simple. However, Platts, which is obviously the home of the JKM benchmark and also the Northwest Europe benchmark that we launched last year, has been at it for over a decade in trying to determine what is the best representation of the delivered LNG to those locations. So this is not a fresh effort. Now, the other requirement for a benchmark is significant debottlenecking. And I think specifically on the Northwest Europe LNG benchmark, there's been either a misperception or a perception generally that the LNG price and the TTF continental
Looks like we have an issue with the connection. Okay. Do we want to?
In Europe that have prevented the market from developing. There was a natural separation infrastructure bottleneck. So with that, I think I'll turn it back to the group and engage in question.
Thank you, Peter. We had some technical difficulties towards the end of your talk.
Sorry about that.
That's okay. We can get back to that after we hear Mark talk about his experience with benchmarks in the oil market. Mark?
Thanks, Anna. Thanks to you and Stephen for the invitation today. And I'm looking forward to the discussion. I've already learned a lot from Dennis and Peter's remarks. And by the way, just for the record, I did not use an AI chatbot to draft my comments. And so if I say anything outrageous, it's all on me. And I want to draw, as you mentioned, Anna, I want to draw, my remarks based on, my experience, having spent a professional lifetime hanging around the oil market. I'm not really an exchange guy. I'm not an expert in contracts, et cetera. So this is kind of more of a practitioner, approach. And there will be some overlap with Peter's remarks, and I'll kind of skim over those bits of it. There's been, I think, and one important point is that there's been a massive proliferation of traded commodities facilitated by IT revolution. This is no longer a bunch of people standing in a pit in New York or London trading a couple of discrete products like crude oil or gasoline. There's been an absolute proliferation of products, pricing points, contract types. As Peter can tell us better than I, you can pretty much trade anything, anywhere, anytime, and in any volume if the price is right. But that said, to have staying power and to move beyond kind of a niche market and a niche product and to really trade at scale, we do need to think about, lessons about what has worked and what hasn't and why. And that's kind of where I'm focusing my remarks. And I want to focus on kind of 5 key attributes of successful markets and benchmarks. First is we need a lot of buyers and a lot of sellers. And we've, that point has already come up repeatedly today, and in each of these kind of key 5 metrics, I want to think about where does our discussion about Europe and this LNG pricing fit in. In the case of LNG, it's certainly a large and growing market. It's certainly been in the news a lot, but it is kind of still a specialized product. You need specialized ships, specialized onshore facilities. Not all ports can send or receive LNG, and so there are some qualifiers there. And in addition, when we're thinking about the numbers of market participants, this talk about joint purchasing feels to me like it. This idea of aggregating buyers is contrary to the basic competitive framework, that's a hallmark of a successful benchmark in terms of having lots of buyers and sellers. Second key attribute, a standardized product. Again, with the oil lessons, why has it been so hard to come up with a gasoline contract? Because every city has a different formula, and that's only a slight exaggeration, by the way. Gas Buddy, the website has tracked 14 different blends of gasoline being sold in the United States last summer. Indeed, the current contract actually isn't even gasoline. To get to a successful product, they had to kind of work down the supply chain to the blend stock. RBOB is the basic blend stock that's used for producing gasoline, not the final product. For the other key refined product contract and benchmark, it took decades to transition away from heating oil, which is pretty much a niche product, to a diesel contract, even though the diesel market is 20 times bigger than heating oil. So where does LNG fit? As I understand it, and again, I'm not a gas expert, I think there are some minor variations in the quality of LNG around the world, but it's a pretty standard product. So that's one in favor. Third point that's also come up already, volume. You need to have a physical volume to underpin, the marketplace. Again, with oil, look at the struggles that have gone into maintaining the viability of the Brent crude oil contract as field production has declined. Not only have other North Sea UK fields been added into the mix, even Norwegian fields are being included now. Similar issues have gone around the Middle East crude oil contract of Dubai as production in the main Dubai oil field has declined. So where does LNG fit? Again, volumes are growing and there's a huge European natural gas market behind it, and we'll come back to that. But, as Dennis mentioned, I'm not quite sure how liquid, if you'll pardon the pun, the proposed pricing point or points are. Fourth attribute, basic infrastructure. You need a kind of a critical mass of infrastructure to support the physical product. There's a reason why the West Texas Intermediate crude oil contract is not traded or priced in Texas. It's priced in Cushing, Oklahoma, because that's where the pipeline junction and storage tanks are. And similarly for refined products, they're priced in New York Harbor, not exactly a major refining hub, but a big place of, storage and doing business. So again, where does LNG fit? Is there significant onshore infrastructure to manage, this product? How is storage used? Is there retrade of it? Because that's part of a successful market. Is that what you want, by the way, in the European context? I know it happens already at some scale. The LNG will come ashore and then go back out depending on where the market, but that's what a successful marketplace does. By the way, an important point, and we'll come back to it again, markets are about efficiency, not about cheap. Even here in the United States, where we worship cheap gasoline, if prices go up elsewhere, the tankers leave New York Harbor and head overseas. Efficiency. One of my questions in the context of today's conversation is, what's being added by the proposed development of this LNG benchmark? I mean, after all, once LNG is delivered, it's just natural gas. And there already are robust European pricing hubs, that we've talked about, NBP, TTF. So finally, and most importantly, I think in terms of developing a successful benchmark on exchange, don't try to manage the market. In my experience, many of the governments around the world that have historically wanted an oil benchmark and an oil exchange, including many of the biggest producers and consumers, when you kind of peel back the onion, their rationale is that they think it will give them the ability to manage and manipulate the price. And one of the enduring lessons is the successful exchanges are where they are because the host countries don't try to manipulate the exchange, and the benchmark. Now, don't be naive. Of course, the United States tries to manage and manipulate prices. In the last year alone, we've seen a release of strategic stocks from the SPR. We've seen President Biden and others jawboning Saudi leaders and U.S. Companies to invest more and produce more. But generally, that interference is not aimed at the benchmark and the exchange itself. Even when the exchanges do show up in the policy discussion, when we get the inevitable talk about the role of speculators whenever prices spike, the famous FTC studies that are undertaken are actually a safe political way to let off steam without interfering in the functioning of the marketplace. By the way, don't get me wrong, successful exchanges do have limits or circuit breakers, I think, in the CME world, Peter, on energy and other commodity contracts. But these limits are typically based on changes in price, not targeting an absolute level. And B, they're limits imposed by the self-regulating exchange itself, not by the government. So a critical observation from the oil experience is you won't attract commercial players at scale to develop a new benchmark and market if they think the game is rigged. So again, the bottom line on this part of it is that it's not an accident that the exchanges, that the successful ones and the benchmarks are where they are. Based on the oil experience, it looks like the European gas discussion could have some potential, for the development of a benchmark and a pricing hub. But my key question at the end of the day is, are you doing it for the right reasons? Anna also asked me to say just a few words on the proposed price cap. And I want to, again, focus on the experience for oil and what it means and how it can shed light on this conversation. A brief review of the details from the oil perspective. The group of 7 countries have put price caps on the sale of both the crude oil and refined products coming out of Russia to accompany EU embargoes on the same. The primary driver of these price caps was concern in the United States that EU embargoes on related services like shipping and insurance would cut Russian exports and result in a spike in prices. The crude oil price cap has been set at $60 a barrel. It was set at a time when Russian crude was already selling for less than that. And as many of you know, Russia has been forced to aggressively discount its crude oil sales to find new markets since the early days of the crisis, way before the EU and G7 sanctions took effect. Crucially, the cap was set after much internal debate at a level that would not threaten existing export arrangements. And U.S. officials have let it be known that they're more than happy for countries like India and China to continue purchasing large quantities of Russian oil at large discounts. For refined products, the caps have been set just earlier this month at $100 a barrel for high-value products like diesel and gasoline, and $45 a barrel for lower-value products. Now, it's important that EU and G7 services like shipping and insurance can be used for Russian exports if the sales price is within the cap. And the G7, promises that it will periodically revisit these caps as underlying market conditions change. So to me, one of the key points from the oil experience is that the objective of these caps is to limit Russian revenue while allowing and even encouraging Russian exports to continue. Now, in a sense, you could say that the caps are similar to what's being proposed in the European, the market correction mechanism, in that they both seek to protect domestic consumers from the risk of sharply higher prices. But again, a key difference is that the oil cap is primarily motivated by a desire to constrain Russian revenues. As far as I could tell, as the G7 price cap discussion was playing out, there was no specific conversation about what price would be unbearable for consumers. Rather, the conversation was all about finding a price that reflects current market realities so as not to make things worse for consumers, while still accomplishing the main objective with regard to constraining Russian revenues. Let me wrap that up. I hope that's useful context, for the conversation here about European natural gas issues, and I look forward to the ongoing discussion.
Thank you, Mark. I really appreciate your remarks. I wanted just to mention that because we had a question, that the slides will be available later on the site where the webinar is. So we'll post it later on within the week, within the next week or so. So please go back and check in for the slides. But also we had a request for Peter to kind of represent your remarks on the bottlenecking on the Northwest Europe.
Happy to. Thank you, Anna. So let's just talk about the difference between the price benchmarks. So there is a concern that the LNG market is too cheap relative to TTF. At least that seems to be what's coming out of the policy reactions. Now, there are good and bad policy reactions to extremes in price movements. When I talk about debottlenecking, one of the reasons for the persistence, particularly last summer when Nord Stream had the explosions, that there was a massive disconnect between the TTF price and the international LNG price. Now, what happened? Germany, actually in a very good policy reaction, focused on expanding the floating LNG regasification facilities and have brought several online into Germany, thereby solving the debottlenecking that is causing that disconnect between the two prices. That is an unallayed good in policy intervention, to cut permitting times, to allow for the expansion of the gas regas facilities into Germany. That solves the pricing problem. That allows the market to function. Now, by October, there was a fleet of LNG cargoes circling Europe waiting for a slot to come in. So the price and the price action of the TTF market and of the international LNG market worked as they currently stand. They do not need additional policy interventions, for instance, normalizing a TTF price for some perceived problem with the spread between the international market price. Those can be solved with positive policy interventions, which is expanding capacity. Remember, this was the largest gas supply disruption in history. 40% of the European gas comes from Russia. Now we're dealing with flows that have to be reversed west to east. We have to increase LNG. We increased LNG into Europe by 72%. And then there's also a significant north-south problem in internal transport and the differences between the price that different countries pay. But that does not mean that the TTF market is broken. It is simply performing its function, which is attracting every possible molecule of LNG to Europe at that time. So the market worked. The other thing is that I wanted to comment on was just the move to over-the-counter trading, which there were some comments that the interventions have not had any effect on the market so far. Well, I think a significant portion of that is that the market is so far below those proposed caps that the market is making a probabilistic determination that they don't need to take an action today. But that does not mean next winter that there won't be an action, right? So it's postponed, but it could still happen. And again, the market does not like it, and there have been alternative venues set up. Now, the market has always had the ability to trade outside the EU. CME, for instance, has TTF futures that are outside the European regulatory regime, and the TTF market is well regulated today with REMIT, EMIR, MiFID, so that the trading of gas within Europe is well regulated, but the price is not regulated, and I think that is an important distinction to make. So today, all the regulatory regimes around TTF are there to prevent manipulation, to encourage financial stability, to promote network balancing effects, and all shippers are licensed. So the market works as and functions as designed. It does not need additional policy interventions on the price management side. Thank you.
Thank you, Peter. Stephen, any questions that you see?
Well, first of all, thank you to our panelists. It's really fantastic, and those are tremendous presentations by everybody. Thank you very much. We have a few questions. We have about 9 or 10 minutes left in our time, so let's take a few of these. A couple of them have been addressed already. There were some questions about the north-south relationship in Europe, and I think Peter, you have addressed those pretty well in terms of the transportation bottlenecks. I don't know if you want to explain the pipeline issues coming out of the Iberian Peninsula, maybe just add a little bit more there.
Well, I think that's more Dennis's world.
That's more Dennis's world. Okay, Dennis, you want to take a crack at that?
Maybe a few words on this. Indeed, Spain has plenty of LNG regasification capacity. So if you want to bring LNG to Europe, you'll always find a place there. There is congestion at regasification terminals in Northwest Europe. That's more difficult. What Peter said is certainly true. There is more capacity available now even than 3-4 months ago. So it is eased down. At the same time, we still see congestion in the pipeline system as well. So we track congestion at what is called the interconnection points between member states. And we see that gas is trying to get out of Belgium and France into the Netherlands and Germany. And that's where there's simply limits in the pipeline capacity physically available. Because as Peter said, the pipeline system was designed to flow gas from east to west, and now it has to flow gas from west to east. That's a totally new situation. This should be temporary. There are measures in place. I mean, there are tools available for the transmission system operators and the national regulators to address this. There is money available because the shippers who want to bring gas through these interconnection points, they go through an auction. That means there's money in the auction pot available to address this congestion. So over time, this issue should also be addressed.
Thank you. Anna, you want to ask a question?
We have a question about there exist LNG price benchmarks in Europe. What are the main differences and advantages of developing the price assessment? What they try to achieve over these existing ones? Dennis, could you take up on this? And this probably kind of relates also to Mark's comments on what a benchmark is trying to achieve.
It's a fair question. This whole idea about this LNG price assessment and benchmark came up, let's say, roughly half a year ago, when there was a big, indeed, as Peter already said, a clear spread between TTF prices and global LNG prices, and people saw there was a disconnect between the two. Many contracts are priced off TTF. That means you're still paying a TTF price, even in parts of Europe where your actual deliveries were more linked to the global LNG market. That didn't feel like a proper combination, at least not a long-term suitable one or sustainable one. What is the difference between the one that we calculate and the one that's the ones that are commercially available? I think the main difference is ours is purely transaction-based. So what most price reporting agencies, in our understanding, do is they have some transaction data, probably not all, and then they call those who are active in the market to get a feel for what are the bids and offers that are out there, and then make their own assessment about what they determine to be the relevant price at that moment in time for LNG deliveries to Europe. We don't do that. We don't make calls. We have all the transaction data, which has a legal obligation to be reported to us, and based on that, and it's limited, it's a highly liquid market, but still, based on that, we make our calculation and we provide those two price assessments, one for Northwest Europe and one for Southern Europe. So what does it do? It provides more transparency. It's calculated in a different way. Whether you trust this one more than the ones which are commercially available, that's up to market participants, frankly.
We have a question, a couple questions from actually our colleague, Hyun-Jae Do, who at the Baker Institute Center for Energy Studies, and he has been studying this issue extensively, and it's one of the people who proposed that we have this webinar, so I want to give him credit for that. And his question is regarding joint gas purchasing. And Dennis, I don't know if ACER is directly involved in the joint gas purchasing proposal, but maybe you can share some ideas on this, or if Peter or Mark have any. As we understand it, it's primarily for spot and short-term procurement, so 1 year or less. How is that going to dovetail with longer-term procurement? Is there a plan to include longer-term procurement in there? If it's just spot, I mean, if it's just 1 term, 1 year, does that mean every year you're supposed to put 15% in and you have to buy at spot? You can't buy that 15% longer term? Any thoughts on this? It's going to affect bargaining power, obviously.
Indeed, as I said, we're not directly involved in this joint gas purchasing. The Commission is in the lead, European Commission is in the lead here. There is no, I think, if I saw the question, what about long-term purchases? As far as I know, there's no obligation to buy anything long-term through the joint purchasing mechanism. So you put in some volumes which you're willing to purchase, or which you have to purchase according to the 15% obligation. It goes through a procurement process, and then you, well, hopefully receive better offers than you would receive regularly through the market. The main idea behind this, as we understand, is mainly to support smaller buyers out there. There are some, including government-owned ones, which were struggling to protect sufficient volumes to their small market areas, and for them, this joint purchasing could be beneficial. How long this mechanism will work and would it deal into long-term context, I don't expect that soon. But again, I don't know the details of the specific mechanism.
Got it. And I think we have one more question from Douglas Hangel here. Is the EU energy platform likely to have any impact on prices or gas flows to Europe? And why would any LNG suppliers participate? I think to some extent, Dennis has kind of tried to answer it in his remarks, but any specific issues that you foresee Europe having problems with, Dennis?
I don't think it creates any problems. It's an additional tool in the toolkit. All the regular commercial negotiations remain available. It doesn't limit EU purchasing. It just adds something more, another option. I think we realize it's a new tool. It needs to be developed over time. Well, it will be tested in the coming buying season, and then we'll see how it works out. And yeah, I would expect it to be evaluated and let's say reformed in some way once the first results are available.
Thank you, Dennis. And I think Peter also has an additional remark on the future of LNG benchmarking.
Thanks, Anna. In the category of let's not make any permanent fixes to temporary solutions or temporary problems, one very significant change is happening in the LNG market over the next, let's call it 5 years. The most significant long-term offtake agreements have happened in the United States. Over the past year, a very large amount of long-term contracts. So the U.S. LNG exports will go up by 60%. Another 10 BCF a day is scheduled to come on between 2026 and 2030. Now, we're in sort of a slack period in new production, but that is changing. That is almost all of it is indexed in long-term agreements to just a formula of Henry Hub. Now, what should that do? Number one, if you export the molecules, you export the exposure to that price benchmark with it. U.S. happens to be the cheapest gas on the planet by a long shot today in any well-traded, well-developed market. And secondly, the majority of that, so let's call it 80 metric tons a year that's being, a million metric tons that's being developed, is not spoken for as far as destination restrictions or on long-term very rigid formulas. So the amount of freely traded sort of spot market gas should dramatically increase in 2027, 2028. So again, permanent solutions to temporary problems tend to distort and slow down the adoption of more market-friendly, more price-friendly solutions. That's just a general view. And I think any of the changes that happen here, with the exception of the increase of capacity and openness of the markets, would tend to slow down that process. So I do believe that the market is about to get significantly more liquid. When I say about to, we've heard this before over the past decade. From 2016 to 2020, it was supposed to happen and didn't really because the infrastructure wasn't mature enough. But from 2027 or 2028 out past 2030, there should be a very large amount of freely traded LNG available from multiple locations from portfolio players globally that will allow this market to mature very rapidly from where it has. And we all want it to look more like the oil market. It may not ever get there, but it should look on balance more open and transparent by that point. Thank you.
Thank you, Peter. It's very helpful. And thank you, Dennis. Thank you, Mark, Anna. Thank you to our audience. We've had really a very, very large group today for joining us. We appreciate it. It's an exciting topic. We expect there to be more developments. And as mentioned at the beginning, we expect to be following up on this topic through the LNG roundtable at the Center for Energy Studies. So thank you all. I appreciate it and look forward to hopefully seeing you all in the future. Thanks.
Many thanks, everybody.